All right, let's dive right in. Today, we're digging through the wreckage of some of the most spectacular hedge fund failures in history. We're going to look at everything from outright fraud to genius bets that went horribly wrong, and even one fund that came so close to collapsing the entire global economy. Let's get to it.
I want you to just think about that question for a second. How can $65 billion just vanish into thin air? This isn't some riddle. It's the actual scale of the financial disasters we're about to unpack, where fortunes were built and then completely, utterly vaporized.
Okay, so before we get to all the chaos, let's make sure we're on the same page. What even is a hedge fund? The simplest way to think about it is like a private, exclusive investment club for very wealthy people. They pool all their money together and use really complex, aggressive strategies to chase what they call alpha, basically returns that blow the average market performance out of the water. But when those aggressive strategies go wrong, boy, can they fail spectacularly. Our first stop is where bad strategy crosses a very serious line and becomes outright criminal. These are the stories of funds that weren't just making bad bets. They were built on a foundation of pure deception.
Remember that number from the start? $65 billion? Well, that's the estimated size of the fraud pulled off by just one man, Bernie Madoff. For decades, this guy was seen as a genius, a pillar of Wall Street. But behind the curtain, his legendary firm was nothing, and I mean nothing, more than a gigantic scam.
So how in the world did he get away with it for so long? Well, it was a classic Ponzi scheme. Here's how it works. First, you promise unbelievably high and steady returns. You know, the kind that seem too good to be true. Second, you use the money from new investors to pay off your early investors. This creates this powerful illusion of success, making everyone think you're a genius. But the whole thing is just a house of cards, and it's doomed to collapse the second that new money stops flowing in. And in 2008, when the financial crisis hit and the new money dried up, Madoff finally confessed to his sons. His own words really say it all. It's one big lie. It was that simple. He ended up getting sentenced to 150 years in prison. Now, Madoff's crime was a massive Ponzi scheme, but that's just one flavor of financial fraud. There's another one that's brought down plenty of giants: insider trading. See, unlike a Ponzi scheme where the whole business is fake, insider trading usually involves a real fund that's just using an illegal cheat code, getting secret, non-public info to make can't-lose bets on the market. And we've seen this play out time and time again. SAC Capital, once a titan of the industry, had to pay a nearly $2 billion fine. The Galleon Group completely imploded after its founder was caught red-handed using a huge network of insiders to get secret tips. And we're not just talking about a few bad apples here. These were massive, coordinated criminal operations inside these companies. But you know, not every collapse is a crime. Sometimes it's just a catastrophically, spectacularly bad bet. This is where we see that razor-thin line between being a strategic genius and a reckless gambler just get completely erased. Just take a look at these cautionary tales. Amaranth Advisors lost over $6 billion in about a week, making these enormous bets on natural gas prices. Then you have the legendary Tiger Management. They famously bet against tech stocks during the dot-com bubble. And you know what? They were eventually right, but the market stayed crazy longer than they could stay in business. And then there's Marin Capital, which got totally wiped out when its huge bet on General Motors bonds went south. 3 different funds, 3 totally different strategies. Same result: catastrophe. So those failures we just talked about were massive, but for the most part, the damage was contained. Our next story, though, this one is about a fund whose failure was so enormous, it literally threatened to trigger a global financial meltdown. And here is the truly unbelievable part. The fund, which was called Long-Term Capital Management, or LTCM, wasn't run by some reckless cowboys. No, it was run by the smartest guys in the room, including actual Nobel Prize-winning economists. They truly believed they had created a perfect, risk-proof strategy. They were very, very wrong. The rise and fall here was just shockingly fast. LTCM launched in '94 with what they thought was a flawless strategy. And for 4 years, it worked like a charm. They were printing money. But in mid-1998, their highly leveraged bets, which means they had borrowed incredible amounts of money, all started to go wrong, all at once. By September, the fund was in an absolute freefall, and the U.S. Federal Reserve had to step in and organize a massive bailout just to stop the bleeding.
So why was this particular failure so different? Why did the government have to get involved? Well, it all comes down to one scary phrase: systemic contagion. LTCM was so huge and so connected to every major bank on Wall Street that if it failed, it would have started a domino effect, taking all the other banks down with it. It was, quite literally, too big to fail without risking the entire global financial system.
Wow. Okay, so after all of these stories of fraud, of hubris, of near catastrophe, what are the actual lessons here? What can we, as either investors or just people trying to understand this world, take away from all this wreckage? Honestly, the lessons are pretty timeless, aren't they? Madoff is the ultimate poster child for, if it sounds too good to be true, it absolutely is. The story of LTCM is a brutal reminder to never invest in complex things you don't fully understand. And all those bad bets show us why you can't put all your eggs in one basket. But the one common thread running through every single one of these stories, it's that unchecked greed is maybe the most destructive force in the world of finance. And look, these lessons are more important today than ever before, because despite these epic flameouts, the hedge fund industry is bigger than it has ever been. Total assets are now approaching an astonishing $5 trillion, with most of that money concentrated right here in North America. The stakes are simply so much higher now. Which brings us to one final, really provocative thought. When you look at the rise and fall of all these giants, from the outright criminals to the brilliant strategists who just bet it all and lost, you have to ask yourself, in this world of such immense risk and reward, where exactly is the line between a financial genius and a reckless gambler? And how do you know when you've crossed it?